Good evening, friends. At the outset, you are seeing the color of the screen is blue. So the connotation is about the water around the castle. So you see the castle to be very small out there. It is supposed to be a little bigger, and it's like this. So the companies which make a lot of money, they are to be they are envy kind of entities. And all the market forces, they try to attack them for destroying that what do you call the castle or the profits and bring it down to the risk-free rates or even below that. And we have seen worst of it in telecom in last 10 years. I mean, from the castle was built to become the biggest reform success, and then in the next 5 years we have seen the destruction of it. Because people could see a company which was nothing became kind of a $50 billion company in just 3 years, and everybody wanted to get into that by hook or crook, and they did that, and you see how the economic moat has been destroyed. So they somehow swam through that particular blue water. So this blue is representing the economic moat. So welcome to 17th study, the economic moat, fountainhead of wealth creation. And so the study is being presented in 4 parts. First is the conventional, the warm-up kind of thing, and really going through the last 5 years, how the stock market has been and which are the companies which have made money and which are the businesses which have made money and what drove them. So those kind of things, and then we'll go to the main theme of the study. And third part is market outlook, how do we look at the markets, and obviously the conclusions. So let's go through the last 5 years, how the markets have, what are the companies which have created wealth. So the concept of wealth creation, the process by which a company enhances the market value of the capital entrusted to it by its shareholders. Net wealth created, this time we have changed the process a little bit. Earlier, any company which has kind of created more than 100 crores, and largest 100 companies, they used to come into the study. This time we are saying if the company it might have created 20,000 crores of wealth, but if it has not beaten the market, it would not be termed as wealth creator. So if you start with a lakh crore and you do 2% compounded and you create 20,000 crores, you will not make it to the wealth creating list. So the companies like Reliance, ONGCs, they have not been able to beat the market in last 5 years, and hence this time they don't find place in this study. So there is this study has become a little more stringent, but clearly if market does 6%, you do 1%, you are not entitled to be called wealth creating companies. So we have 3 categories: largest, fastest, and the most consistent. The biggest wealth creator this time is the biggest top 10 wealth creating company. The biggest is ITC with 118,000 crores in last 5 years, TCS 108,000 crores, HDFC Bank 74,000 crores. So like that, Jindal Steel, Hindustan Unilever has been absent for quite some time, for 8-10 years. First, between 96 to 2003, it was the largest wealth creator for 7-8 years, and then it just disappeared from the list of 100, and now it has again made a comeback in last 2 years, and this year it has, after a long break, it has come to the top 10 wealth creating companies. I am sure this company has a chance again. My sense is that this company under the current leadership is likely to see, it will challenge ITC also. But the real thing is that consumer giant ITC, which at one point of time under the government excise conditions and all, it was literally facing extinct, has really become the largest wealth creating company. And after that also in this current year, it has further moved on. So the real winners are the consumer monopolies at this point of time. And incidentally, the fastest wealth creating company is also a consumer company called TTK Prestige. And this is very, only in dot-com boom time in 2000, you found that fastest and the biggest wealth creating companies were tech companies like Wipro, Infosys, TCS and all. But this point of time, it is a consumerism, which is, and we know why the consumerism. It's not that it's a by chance, it's not a dot-com boom, it's not it's not a commodity boom or real estate boom. This consumer is going to stay and it's going to become much bigger. Because we are talking about an economy moving from $1 trillion to $2 trillion, and we knew from 2007 that this consumer is going to be fuel. But we have seen this is just about the startup. The real consumerism is going to be ahead in next 5-6 years when the economy will move from 2 to 4 trillions in next 5 to 6 years. So in consumerism we have seen nothing. I mean, maybe the stocks may perform or not perform, that's a different thing. But I think real consumerism, big, huge consumerism is ahead. Then the most consistent companies, which are the real true blue chips in the portfolios, and Kotak Mahindra Bank, Siemens, some of these names, when they pop out, I mean, they look to be really staggering. Kotak Mahindra Bank, 48% compounded for 10 years. Siemens, 44%. Sun Pharma, I mean, 10 out of 10 studies. I mean, in last 10 studies they have been present. So this is almost 15 years they are in the wealth creation. Asian Paints, HDFC Bank, Motocop, SDFC, ACCA, Ambuja and Infosys. But not only that, they are there for last 15 years in the last 10 studies, but look at the pace of wealth creation. I mean, anything you do 40%, it's doubling every year. So the lowest is Infosys, which is 21% from 2000 to 2012, which is quite staggering. So these companies, they have done amazing amount of wealth creation, and most likely these companies will beat the market. I mean, if you take all these companies put together, my sense is it will beat the index in next 5-10 years without any problem. So these companies are very special set of companies, and they must, I mean, it's not that the companies have created wealth in the past, there is no future. In fact, this particular study of moat investing or moat-based investing really confirms that the companies which have delivered in the past are the companies which will keep delivering in the future. So actually, in the stock market, the most important thing is to see the future. Actually, through the eyes of moat, you can see the future of the companies which are going to make money or keep making money. So if you have to know which is the next ITC, it is the ITC itself. If you look at the Sensex has done about 6%, so it's largely, it has been kind of doing, after that deep plunge, again come back and then slowly market has been recovering. So 13,000 was the index in 2007, which is now at about 17,000. In March, now it is about 19,000. So 5 years, 6%. The wealth company, I mean, of course, survivorship bias is there. We have taken the companies which have beaten the index of 6%. So clearly these companies have done about 20% compounded. So clearly, I mean, this is not you are going to get, this is a clearly chosen set of companies, but these companies have done 20% compounded. Sensex EP has grown at 19%. Wealth companies have done about 21%. So there is not much of re-rating anywhere. I mean, the whole market has remained flat, and we'll get to see in market outlook that there is not much of re-rating in the market, and markets are in a very, very interesting situation right now. So what kind of businesses have created wealth? The financials, the banks and the NBFCs, they have been the largest part of wealth creating set in last 5 years. And even in the last study, this had emerged as the largest wealth creating group. And this is, I think this is going to stay as amongst the largest wealth creating group. And actually, in one of the findings, I mean, you will see a little later, that all the banks which have been part of this wealth creation study have, even the ones which are not good, they have beaten the index. There is no bank which has lost you money. So this segment, because of lack of licensing, I mean lack of entry of new entrants and exploding opportunity for the businesses, I think this particular group is making huge amount of money, whether your chosen one is a PSU or a multinational bank or a private sector bank or public. Of course, if you choose rightly into HDFC Bank or a Bob or something which is doing better than its competitor, obviously it will do much better. But I think portfolio must be positioned 25-30%. In fact, after this study, I was feeling that instead of 25%, we should be 30 to 35% into financials. Consumer and consumer products is second biggest category, and if you include auto, which is another 10%, I think the consumer segment is going to more like 55-60%. So one of the funny thing about consumer sector, consumer companies, is that entry barriers are very, very high. So in next 5 years, if any segment of consumerism you think is going to be big, say you like two-wheeler or you like four-wheeler, you like say milk products or whatever, the entry of new, significant entry of any new player is going to be extremely difficult. In real estate, if there is a boom, there is a 10,000 per square feet profit, 10 more can come overnight. Or in jewelry somebody can come, and many other companies you can come in. But finding this branded consumer companies is going to be extremely important. And that's why the scarcity value is telling in the marketplace right now. And you are seeing every day, the companies which are expensive are becoming more expensive. And it is almost attaining the .com kind of a scary valuation for some of these companies. Metal mining, we know, has been one of the boom period they have gone through. Technology has been fairly subdued, but I think having made 10% and as a group has beaten the index in last 5 years. So these are the businesses which have been significant wealth creators. Cement has been quite subdued. Capital goods, we know that cyclically it has been hard. So I think some of these beaten down sectors could be an opportunity for as the economy comes back, because there is always a cycle. When things are down, you don't know how it is going to go up, and when it is at the top, you don't know how it is going to go down. So I think some of these businesses which are down and out today, they are definitely going to make comeback. So don't be disheartened. I know everybody's portfolio, including mine, we have this, companies which are not done well, and quite a few of them. So these companies are definitely going to do well, and so you'll be surprised that the companies, the businesses which are looking to be out, they might outperform for 1 or 2 years. So those kind of situations can come. Companies, the market has found difficult to price correctly the companies which have grown at a very hyper rate. So any company which grows beyond 25%, typically market finds it difficult to value it fully. So if you have any insight at any point of time that this company is going to grow for 5, 7, 10 years at the rate of upwards of 20%, most likely markets will give you a terrific opportunity to make money, because markets find it difficult to do the compounding and remain optimistic for 5, 10 years at the rate of 30, 35%. And that's why high growth, high quality companies, they keep making money despite optimism shown in the high P multiples. Per se, high return on equity, high competitive advantage, or high rate of return in a company doesn't guarantee a high rate of wealth creation. Because what happens is that whenever profitability is high, market immediately rerates the stock and it stays there. So that's what really happened in Hindustan Lever when it was very profitable in 2000. But the earnings growth expectation bit was 25%, and when the earnings growth didn't come, it didn't perform. So per se, having high profitability is not guaranteed to wealth creation. It has to be associated with sustained growth in the earnings. We looked at some of the valuation metrics, and here we find that across the P multiple, which is the most popular way we value the stocks, whether you buy it below 10 or whether you buy it above 30, anywhere between 10 to 30 or even higher than 30, you made almost same level of return. In fact, if you bought below 10, you made 20%, and if you bought above 30, you made 25%, which is a very strange kind of thing, but this is right. This is what has happened in the last 5 years. But typically in earlier studies, we used to find that, if you buy below 10 or below 7 or 8, you were guaranteed almost not only good return, but I would say almost a multi-bagging kind of situation. So right now, in this 5 years, have been strange, where the very high quality, expensive companies have done much better than the cheap, low quality companies. They have been completely neglected by the market. And maybe the reason